This is a recent trade that I've done. There's quite a few good learnings out of it that I want to go through. In general, yeah, I've got this sort of general theme of my analysis is pretty good, then followed up by some less than perfect trading, usually on the emotional side and usually on the scared emotional side. Anyway, this is simo. It's not really a semi, as I understand, but sort of in that space. Powerful sector, powerful chart, powerful earnings. It broke out here in at the end of July. Big volume, big earnings, pushed above previous resistance, pushing out of this sort of little base thing here. So I didn't actually buy it straight away. I normally would buy here. No, I don't know why I did in this case, but anyway, I didn't. Probably a little bit of luck there, because then it did sort of pull back to obviously to here, which is sort of roughly to previous resistance, and then bounced off of there. So I bought it on the 24th of the 8th, which is exactly here. Now I bought options, not stock. So at that time, I bought March 18 $85 calls for $3.80. So my thinking then with the applied volatility wasn't too bad. That was what is it? Over just 8 months or so. So I thought, well, that gives me time to make money here. I like to buy these breakout type stocks. Studies have shown, so-called these Bible gap ups, BGUs. Studies have shown that it can be just such powerful trades. So yeah, this is a sort of big focus point of mine. Anyway, so of course, then the stock just continues to just not do much to prove me wrong in the short term. Now, okay, so I managed 6 different accounts. I got the shits with this for some reason. I sold it in all but one account in the 11th of 12th of November. So these US dates are back to front. So I sold it here. So I sold those options for $1.30. So $3.80 to $1.30. 60 or 70% loss there. So not great. Now, honestly, I sold it just because out of fear. Now, because I was sort of testing these options, the actual dollar values in my portfolios were very small. The percentages are very small. But I still sold it anyway. Also, just hate seeing red, I think, in my accounts. So sold it. I say out of fear. Didn't like seeing losses around. Anyway, but I didn't, for some reason, I don't know why, I didn't sell it in one of the accounts. And so it was sort of still on my radar. And then it comes out and just has another sort of huge breakaway gap here. And things sort of just powered along. So it's taught me a few lessons, this one here. The first one is, especially with options, and this is just a bit different to sort of traders, is because the options had already gone down so much, and because the dollar value was so small, there's almost no point in selling it. You might as well just roll the dice at that point and just see if it can come good. And this is the only time where I sort of sold out of an option position, and the stock's reversed and sort of done okay since then. So I think rule number one is, and again, this really depends on the positions, your initial position size, is to try and let these things just work through. Lesson number two. You can see here, this is a 200-day moving average. It wasn't actually doing a whole lot wrong. Yes, it wasn't performing, but it was sort of only just pulling back to previous, granted a little bit further than previous resistance, but nothing that it sort of hadn't done before it decided to sort of power along. So there's no real good reason to sell it there. In fact, if anything, I should have been actually buying it again. Had another big sort of earnings move here, sitting above the 200-day, around that 50-day moving average. All the indicators were there, if anything, to be buying. I've identified in the previous video that there was an October low and the Nasdaq at around October 5th-ish. So around here, this is one of those stocks that was sort of just bottoming out. What I found is if the market's ready to go, you can be a little bit looser on the individual charts. The more important thing is to start to get in at that point. Okay, so what I've done is today, that last account, I've actually just sold the options. So I sold those March 18th $85 calls for $12. So it's obviously a pretty good return. $3.80 to $12 is great. I sold them and I put half in the bank, so I've locked in a profit. And I've actually reinvested the other half into June 22 $120 strikes. And they cost me $2.65. So because $2.65 is fairly cheap, that's allowed me to buy roughly, it's actually a bit more than twice the number of options contracts that I had in the initial trades. In the initial trade at this small account, it was 300 or 3 times 100, so 3 contracts. And in this one, I bought 7. So it's actually given me more than twice the exposure, admittedly at a strike price that's much further out. So if I go through the maths on what I'm thinking there, okay, so this is my scenario. If I do nothing, so let's just look at the $95, which is sort of roughly where it is at the moment. If I do nothing, at expiry, those $12 options would be worth $10. So I'm starting to sort of get hit with a time decay value in the last 3 months of the options there. So I'm very, very aware of that. So even if the stock price does nothing, my profit starts eroding. Heaven forbid if the stock drops back down to $85 or less, I lose the whole lot. And here's some scenarios if the stock sort of moves up to 115, and just what happens if the stock really powers along. I know that's an aggressive assumption, but these things can happen and do happen from time to time. Anyway, so let's just say the stock moved to $115 by March. I'd make $8,000 on the trade. So instead, what I've done, sorry, that was in a scenario where I do nothing. Instead, what I've done is, like I say, I've sold those options, kept half, put that in the bank, and put the other half into more contracts. So let's just stick with the $95 scenario. So sold them all. Yeah, 300 times 12 is $3,600, less than $990 that it cost. So the profit was $2,600 on the whole lot. Now, with the sale proceeds, I've bought, it's actually 700 contracts. So, yeah, 700 contracts. Now, let's assume that the stock price is $95 in March. That means the option price is $1.18. So I'd actually lose a bit on that purchase. So overall, if I add the profit what I just sold for, plus I just take the loss in that second round, that's $1,600 overall profit versus $2,000 on the do nothing scenario. So obviously the do nothing scenario, if the stock price stays the same, is actually a bit better. Going back to that $85 thing, I'd lose $9.90 if I just wait and the stock price drifts off. Or at least in this case, I've made some money. In fact, overall, I've doubled my money, which is pretty good. Okay, let's just say the stock price powers up to say $115. The do nothing scenario make $8,000, whereas this scenario make $5.5. And then the scenario where it goes nuts, I actually make more money by doing what I'm doing, and the reason for that is I've put, I'd say more than twice the amount of contracts. So scenario where it does nothing, where it goes nuts, I make actually more money, and that sort of difference expands. Let's say for into $200 or anything sort of silly like that, I make even more money. So I like this because at least it's allowing me to lock in a profit now. So look at the sort of great trade like Mark Minervini. They keep saying, and I probably should try and listen to it more, that they do try and lock in profits, because you never know if the stock's going to reverse, and if anything the last 12 months has taught me that is so true. So and this mentally and this is what I'm really sort of trying to push towards now, is mentally allows me to stay with the trade. Whereas I might be getting scared if I just said, right, I'm going to do nothing, but I'm going to get scared, I'm going to lose the whole lot. Whereas this scenario, I can say, right, well, I've locked in my profit, I can let the rest run, and I'm hoping that mentally I'll be able to deal with that a lot more, which I sort of did with, well, I should have done with Amberella, because I sort of had already did this trade, sort of got panicked anyway. But anyway, and then every now and again, what I'm hoping to really make my money on is a stock that does, something like this, just goes nuts for me. This can happen with growth stocks, can happen with any stock. Time has shown me that. And so what I'm trying to achieve overall is getting free leverage in black swan type events. So here I've got the exposure to it for free, or in fact I've even made a bit of money by selling now, and then if every now and again I get the big one, that's where I'm going to make my money. So all of this is sort of has to be taken in context of how much every portfolio you're going to allocate to it. Now, I'm thinking I need to go in with the mentality that because I panic sell, I'm going to try and have my position sizing such that I assume that I could lose a whole lot and deal with it. So most of the sort of trading sort of maths suggests that you want to risk anywhere from 0.5% to 1.25, 1.5%. So if I allocate 1% of a portfolio to this, now that might increase over time depending on how the sort of numbers work out. I mean, the numbers actually saying that I should be having a higher allocation than this, but based on my previous results of options. But just say it's 1%. So if the trade goes against me, I'll lose my 1%. Now, am I happy to deal with that, live with that? Well, so yes, I am. But then in the context of that 1% could turn into a very big percent. So in this case, let's say that 1%, which is let's assume there was a 1% trade, so that was $990. So that just keep the numbers easy. So that was a 100 grand portfolio. Then, if things go really right, that could have turned into a $22,000 position. So it's 22% return on my 1% position. So just say if I was sort of trading the stock and I put say 15% of my portfolio in, that's 15 grand, and the stock's gone from 95 to 150. So that's a 55. So we'll go 15,000 times by 150 divided by 95 is 23 grand. So it's actually about the same as what I'll make on the options here. Now that's not as good for the sort of smaller returns. I accept that, but equally the 1% is as most as I can lose. The problem with putting a stop loss on a stock is that, well, that's not always the case. You could get slippage, especially if you're not trading during the day, like I am. So it gives you a lot more stress because you don't know if you're exactly going to get out where your stop loss suggests. So, whereas at least the option, the most I can lose is the option premium. Okay, so what I'm going to do now is with Simo is I'm going to try and hold it for the next few months. So I bought the June 22s. That's as far out as I could go. I'll do this more in upcoming videos, but the option decay really starts to hit after the last 3 months. So I've got an alert set that so June 17, 2022 minus 90 days. I really need to start sort of making decisions at that point. What I've sort of found with Simo is you can actually let it go sort of less than 90 days if the stock's really moving strongly and powerful. But I'm going to need to try and make a decision by then to either just sell or roll out to the next expiry date, and maybe just rinse and repeat. Anyway, we'll revisit that at some point.